assets that you own give you the ability to declare loss, which as physicians, we don't get to do that. That's one of the benefits of being a business owner and having passive investment is that you can declare loss, not have to declare a large amount of income, even though you've made that income in some capacity. And so this allows you to do that.
Welcome to the Physicians and Properties Podcast, the show where we teach you how investing in real estate can give you the freedom to practice medicine and live life how you want.
Doctor! 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 Doctor!
Now, here's your host, Dr. Alex Schloe.
Hello, everyone. Welcome to another episode of the Physicians and Properties Podcast. As always, so glad that you're here. Today, we have an incredible guest, Dr. Franky Davis. Hey, Franky, how you doing today?
Great, man. Thanks for having me on.
Absolutely. Hey, thanks for hopping on a Sunday morning. Really appreciate it.
Yeah, we're getting the kids up and rolling and about to head to church after this, so I'm happy to knock it out for sure.
Good deal. Good deal. You look your Sunday best. I don't yet, so got some work to do to look like you. Awesome, man. Well, thanks for coming on the show. Your story's super inspiring. I think folks are really going to learn a lot from it. And like I said, really appreciate it. Do you mind telling some folks a little bit about yourself?
Absolutely. So, like you said, my name is Franky Davis. I'm now an orthopedic surgeon who is about midway through my third year of practice. We practice in southeastern United States, southwest Georgia, in a small rural town. I've been interested in medicine for as long as I can remember. And as we sort of transitioned from training into practice, kind of became anxious about the financial situation that physicians are plugged into. I was married early in medical school and then had our son as a third year medical midway through my general surgery rotation. So we sort of navigated that best we could. And then jumping into residency as a second year resident, I just became pretty stressed out about being hundreds of thousands of dollars in debt and not having a dime saved for retirement. So that's sort of what sparked my initial interest in real estate and how we started going down that road.
That's awesome. What was it like having a newborn and being in surgery residency?
It was tough. We retrospectively laugh about it, but it stings a little because my son was, I think he was 2 probably. The time adds up when we started residency as an intern. And then for orthopedic residency, second year and third year are kind of the hardest when you're on first call. So several comments we throw around is, my son's name's Trey, and he multiple times told me I could spend the night at his house if I wanted to, which was funny retrospectively, but at the time kind of hit me where it hurt a little bit.
Yeah.
Then he would ride around with my mom, and I was in Chattanooga, Tennessee at the time, and he would point and be like, "Look, that's where my daddy lives," pointing to the hospital. So tough time for a little while, but my wife was fantastic. She sort of was the sugar mama and worked full time as a special ed teacher and took care of him and brought him every night I was on call, and we'd eat dinner at the hospital and he'd run around and look at the fish tanks and had a great time. So we made the best of it for sure. Memories, even though it was tough times.
Yeah, that's definitely unique memories. And luckily he probably isn't going to remember too much of it, but yeah, that probably was a little bit of a gut punch.
Yeah,
at times
he's
for
good
sure.
though. He saw that even if he doesn't remember it, I think as a young person, he knows how hard of a struggle that was for us. And now we're in a situation that's quite a bit better. So, the next sort of parenting hurdle is teaching your kids how to stay grounded when they live, how they live. So that's a whole nother podcast probably.
Yeah. Well, while we're on that, do you have any tips you think or some things you've been learning in regards to that?
I think it's a moving target for my wife and I. We try to set up chore lists and without browbeating him about, the cost of things. We try to help him understand that each thing that he wants and receives has some sort of work metric given to it. We're trying to establish that. He's only 9. So we just try to have him independently have some tasks he has to check off and do. And then we have a little allowance that he gets to. And then when he gets that allowance, he has to give a certain amount of it to donations and a certain amount of it to savings. And then a certain amount of it, he can kind of spend what he wants. And it's given a little bit of value to the dollar because he'll be a little hesitant about buying things, whereas if he was previously walking around, it's easy to say, I want that and that. And you've seen him kind of refrain that a little bit. So it's been a neat transition. We'll try to do that as we move, as he moves into being a teenager and a little bit later before he's a young adult, trying to teach him that you can use your money to make money. And it's not about earning and then spending, exchanging your time, then receiving money and then spending said money. There's a step in between that can really help your financial future. So that's really what I want to kind of teach him. And I haven't quite figured out how to do that.
Yeah, Trey's going to learn a lot, and I'm sure he already has from you and your work ethic and so forth. I heard a podcast with Brandon Turner, Better Life, Brandon Turner from Bigger Pockets, of course. And I think the guest name was Scott O'Donnell. He does a lot about financial education for kids.
Yeah.
And he talks about, we're going to start doing it here soon for my 3-year-old because I think it'll be helpful. But he talks about having 3 jars, and one's a savings jar, one's a spending jar, and one is just like a tithing jar. And
Yeah.
basically, it kind of like rewarding them for when they're doing things around the house or kind of doing chores and so forth, they can get a quarter that goes into the jar. And if they put it in the savings jar, you'll match that. And if it goes
Nice.
into, yeah, it's really cool. And then, but if they do something wrong or you want to discipline them, then you tell them that they need to take a quarter out of the spending jar. And so he said for young kiddos, 3, 4 years old, it can be really helpful for them to, one, understand kind of the value of money, but also as a discipline tactic because they've figured out, hey, I worked for this and now I have to give it to dad, or give it to mom because I did something wrong. So we're going to try and implement that here soon and see how that goes. I'll let you know if we have any success.
Yes, man. Maybe we just need to touch base every 6 months and see how we're
Yeah.
doing.
That sounds awesome, man. Yeah, because parenting is the hardest but best job that we have for sure. So that's really cool. Yeah, sorry to take that pivot there, but yeah. So you were saying that during residency and after graduating, you had a pretty significant amount of anxiety in regards to the medical school debt burden that you had and everything else, and getting started as a new attending and getting started saving for retirement. What was that like? Kind of that transition piece from residency as an orthopedic surgeon and a newborn to now practicing as an attending.
Obviously, quite a bit of life change. Probably the biggest thing we've tried to hold on to the reins is lifestyle escalation. It's real easy to get out, and all of a sudden you're seeing, a little bit different amount of money being deposited every month than you did for the previous 12 years. It was an interesting thing to navigate, but my wife and I really tried to take that on head on and divide our finances and particularly have them delegated to certain things that pushed our goals forward so that we didn't have this money that was just sitting there burning a hole in our pocket. So I think that was kind of step number one. Our investment career started as a second-year resident. We can dig into that in just a little bit before I really had any disposable income. So that plan was already in place. So once we had kind of confirmed that the model we were going to try to pursue with our personal real estate investing was a model that we could replicate, then we dedicated a large amount of my after-tax dollars to be dedicated to capital that we could then leverage to buy real estate further in the future. So that was kind of already a part of the plan as we transitioned to my income escalating, and it made it a little bit easier for us to transition without losing control.
Yeah, that's such a tough thing. I talk to folks often, and lifestyle creep is a big thing that they struggle with. I mean, yeah, going from residency making peanuts to all of a sudden making more significant income. And I think part of it is just who you surround yourself with too, or who you are surrounded with. I mean, you see everyone probably pulling up into the hospital with their brand new Tesla or their super nice car and their Rolex watch. And it's hard not to want to join in regards to that. So I think I've told this story on the podcast before. I was laughing because one day I pulled into work. I have a 2011 Volkswagen Jetta that's all hail dented up. And I pulled into work, and one of the other providers has this 2007 Honda Civic with duct tape holding up the bumper. And another one has this little Mazda hatchback. And we all pulled up about the same time. Just 3 really crappy cars. And the pharmacy tech comes pulling up with a Tesla that has those doors that like open up like this. Yeah, the pharmacy tech. And we're like, here we are, the 3 providers rolling up in these terrible cars, So I think it's tough to do, but it's just so worth it to hold off on that lifestyle creep and understand like, hey, it'll come. Let's try and just space it out over time as much as we can while we're getting some income producing assets going forward. Yeah, absolutely. Well, let's talk about it, man. Let's talk about how you got into got into real estate during residency, buying those 57 doors. Yeah.
My program in Chattanooga, we did have a night flow system. We had a queue call system. And on those shifts, there's a decent amount of time in the hospital where you're just walking around and either going from the wards down to the ER, trying to handle consults, peds, and adult ER, bouncing back and forth. And once I decided that we were going to try to diversify ourselves into real estate, the goal number next was I had to become as educated as I could in order to navigate that confidently and to not get myself in trouble. So you already referenced Brandon Turner. Brandon Turner is probably super vital to a lot of our aged folks who are getting involved in real estate. So I would just put a Bluetooth headphone in one ear and I'd walk the hospital and listen to podcast episodes. And then I would dictate in my notes app notes associated with the episodes. And then after the fact, on the weekends, if I had some free time, I would just read the notes. So I could kind of reiterate the terminology and reiterate the points so that as I started navigating that at each sort of phase, which I'll kind of get into in just a minute, I would be confident that I knew what I was doing. And that would eliminate a lot of the analysis paralysis, which is what really curbs people's ability to take the next step. I did that. I listened to probably 200 episodes of the podcast. I listened to probably 20 to 25 books, audiobooks on Audible. And I think that's one of the things they talk about, the automobile university or whatever they say,
Yeah.
that you can learn so much more now with that little phone in your hand that has access to the world. And that really helped me a lot as I was trying to become educated and confident, because as we know, throughout the medical track, you don't learn anything about financial management or investing or anything of that nature. So that's how I sort of got started. And then as I felt like I was becoming educated, I started trying to assess what my big problems would be as I started to try to invest early. Obviously, when you're looking at things as you bring them to a real estate deal, it's either you have access to deals, either you have money, you can bring money to the picture, or you have time and hustle factor. And I was like, well, I'm 0 for 3. So we have to figure out kind of what I'm going to be able to do. And the next phase was I needed to network and start building my team so that hopefully I could maybe delegate a lot of that and eliminate my active involvement in each step of the game. And what we did next was I would just jump on the phone and I wanted to formulate relationships with people in the industry. And the first thing I needed was money. I needed to find a banker. There's no point in me kind of going down this road if I can't get a banker to go out on a limb and lend me some money so that I can buy properties, because making whatever it was, 47 grand a year or whatever, is just, I didn't have a whole lot of expendable income to be able to do that. And then I didn't look fantastic on paper either, because I didn't have a ton of purchasing history. I didn't have a long-term job that they could reference because I was in transition in med school. I had a ton of medical school debt. So then I started trying to figure out, okay, well, what sort of lenders would lend money to me potentially? And that led me to community banks. And the thing about community banks that is talked about all the time is they can hold the notes on their books. And since they don't have to sell those notes up to Wall Street, then they have a little bit more liberal lending ability. They can kind of stretch things and make accommodations for certain scenarios. And so then I just got on the phone and I called probably 70 community banks around the Southeast. And I would just kind of have a pitch, something like this. Hey, my name's Franky Davis. I am an orthopedic surgery resident in the middle of my training. I've already signed my contract and my future income potential is this. And I would love to formulate a relationship with you. My wife and I are interested in buying, and we had a criteria. So I wanted to buy pitched roof duplex in this town with these macroeconomic drivers built within the last 10 years, already rented under market so that I could add value and stabilize that property. And just being able to say that to a lender over the phone was enough to almost instantly give me some credibility. Now, I was met with a million no's, 69 no's and one yes, but the one yes was huge. And they came to the table and lended me the money I needed to buy my first deal.
That's awesome. Yeah, I think sometimes folks don't think about the community banks and think they have to go right towards these big box banks. And you're so right. Like finding a good community bank and getting a relationship with them, they're understanding and they're able to accommodate, the fact that at the time you were making nothing compared to what you were, and see that future income potential. And I know we had talked about it offline before that this wasn't the physician loan. You weren't going to buy a primary residence. You were going to invest in real estate, and you got a crazy deal, which I'm excited to talk about. But yeah, I think you put the preparation in, you understood what you were looking for. You had your buy box figured out, and you made the bank feel comfortable with, hey, where are things going in the future? And this guy knows what he's talking about. He's not going to just go blow our money and we're going to foreclose on this property. So that's really cool. And thanks for sharing your pitch with folks. I would encourage folks to use that pitch with banks when they're getting started, for sure. Yeah. So what happened next? You get this community bank, they give you a yes. What's next for us?
So then I had several markets that we were planning to target. I was in Chattanooga, Tennessee at the time, and we were not going to end up long-term in Chattanooga. So we were moving to Southwest Georgia. And my criteria for where we wanted to invest was within 3-hour driving distance. Retrospectively, I don't think that would have been a hard stop, because we started investing remotely and ended up investing remotely, even though I'm an hour away from the market. I almost never go really to check in. But so we targeted that macroeconomic market within 3 hours. I wanted to be around 50,000 people to 115,000 people or so, just because I wanted to eliminate private equity and Wall Street money from saturating the market. But I also wanted to be able to kind of compete in a market that was a little bit above the mom and pop investors who are just utilizing a solo 401k to try to buy their a house that they can rent. I wanted to try to see if I could whittle my way into that middle ground. So we targeted an area that had 3 major macroeconomic drivers. It had a base, had a large hospital system, and then also had an undergraduate school. So I felt like the rental potential was strong and the prices were not horrible. So that's where we initially targeted. At that time, I moved from securing financing and targeting sort of my market from a macroeconomic standpoint. And then I had to figure out how to get a deal flow going while I was working, as a resident, which was kind of the next step. Once we decided we were going to do that, similar conversations to what I would have with lenders, I got on the phone after research about commercial brokers. I wanted to talk to guys who were doing higher volume portfolios, bigger deals, understanding kind of what the big investors in the area were doing. I didn't want to necessarily, I was fine buying a single family house if it checked the box, but I really wanted to kind of start formulating the relationships with those men and women who are doing the bigger things. And so I looked at Crexy and LoopNet and a lot of these commercial MLS platforms, and I just would find their names and call them so that, I could start formulating those relationships. And the conversation was similar to what it was with the lender. Hey, my name's Franky Davis, trying to buy properties in this area. This relationship has the potential to be quite a bit larger in the future if you're able to kind of work with me, but not necessarily off market. But if you would consider me, if you find a duplex or single family home that fits, this, and this, what my buy box was, like you said earlier. And that's how we ended up finding our first duplex deal. It was a 3-2 on each side within a micro market outside of the college. Little campus region, and they brought it to me as a pocket listing. So they brought it to me before they put it out on the MLS, which I think is another thing that is talked about all the time, but trying to eliminate the majority of your competition by finding off-market deals. And so my first one was kind of off-market, even though I did utilize a broker. And we were able to then make an offer quite a bit below market and settled in an opportunity for me to really add value and kind of hit wasn't a grand slam, but it was definitely a single to right field, which was state. And I think if you can do that, 100 times, then you're doing pretty good. So.
Yeah. Every deal is not a home run, but you got to pick up the bat and swing to at least have the chance. So that's awesome. So 3-2 duplex. What was that like for you? Still in residency, buying this duplex and then getting it fixed up. How was that process for you?
It was obviously met with some hurdles that were unexpected. Now, before I ended up closing, I did a ton of research and had a bunch of phone calls with property managers in the area. Before we selected this micro market, I wanted to make sure that my ability to manage the manager remotely would definitely be possible, because I don't have time to be answering phone calls in the middle of the night. And so we found a property manager that was okay in the beginning and subsequently had to part ways with them because they weren't really checking the boxes like I wanted. And that allowed us to find a property manager that we still have a relationship with today. And she's a rock star. She handles the day-to-day. She vets tenants with the criteria that we've discussed on the front end, and she does walkthroughs and handles all the financials, and also will go to court for me for an eviction. So it's really a nice way to do that. I knew in the beginning that we weren't going to stop at one. So I felt like if I was going to buy one and I was going to buy 100, I needed to have the same system in place and start trying to hone that system so that as we grow, I don't necessarily have to relearn anything. It was just a way to kind of expand that and scale up. And we've really been able to do that over the last, 3.5, 4 years.
That's great. Yeah, I think one thing kind of going back to your journey and your story is I think you did a lot of research to make that analysis paralysis minimal, or at least probably make you feel more confident in the whole process. I mean, not only did you take a lot of time to find a good bank, so you knew your lending parameters that were going to be really important. You talked to brokers, you established those relationships with brokers, you knew what they were doing, what was working in the area. And then with this property, you reach out to property management folks and you realize, hey, this is how much I can rent for, and this is what the micro market looks at. And I think the property manager piece gets missed a lot of times. That's such a beneficial contact or relationship to have, because they not only understand the market at a micro level, but they also oftentimes will have other deals that are coming up and they'll be willing to offer you. Yeah, exactly right. You're smiling. Yeah. They have other deals that they'll be willing to bring to you. And so it's another great contact to have, a great person to have on your team.
For sure. I think I agree with that 100%. And she's a part of my due diligence now in the very front end. And, talking about the analysis paralysis thing, for me, I was very aware of that would come and I would have to. So my strategy kind of has been, and I've heard this in different sort of forms before on different podcasts, but was to try to didactically check every box so that it whittles the decision down to one binary emotional decision. That way at the end, I can say, okay, it checks all the boxes objectively. And do I feel good about it? And then if I feel good about it, it's a yes. And it's not a hard decision. If I don't feel good about it, it's a no. And that's fine. And I've made that no decision several times. And I feel like my only real mistake up to this point has been I didn't necessarily buy a deal that probably would have been a good deal. And so I have a couple that I've left on the table. But since my wife and I live in a scenario where my 1099 income, earned income is enough for us to live and retire and be fine. And we don't have to live on the money from this. I need to be more conservative, but that sort of conservative mindset also has really eliminated a lot of the analysis paralysis and has allowed us to jump when that opportunity presents itself.
Yeah, absolutely. That's great. What came next after the duplex?
The same broker formulated a relationship with him, and probably 4 months later, we got that duplex stabilized. It was rented already, but it was a little bit under market rent. So we were able to bring it to market, held it for a couple months, and really stabilized that property. So it secured the confidence that the lender had in us. The next deal was kind of crazy. It was a guy who was a contractor and a developer. So he developed neighborhoods for probably the last 30 years, multi-millionaire, and was kind of transitioning out and offloading portions of his portfolio. And he was selling 5 single family homes in one small little neighborhood. So these were probably B minus location, consistent rental history on slabs, pretty safe bets. And I got them under contract. At this time, the prices seem laughable, but it was around $85,000 per 3-2 times 5. Wow. But in our due diligence period, we came across some pretty big delayed capital expenditure. This guy had such good systems from a construction standpoint. He had more money in the bank than he needed. And so if he'd had a roof go out, he'd just call his team, they'd go replace the roof. If he had an HVAC go out, he'd just call his team and they'd go replace the HVAC. So a lot of that stuff wasn't necessarily getting checked off as he was going. So I had to negotiate that in. And it was a lot of back and forth and a lot of kind of butting heads a little bit through my broker, which I'm thankful for. Even retrospectively, I talked to him about how hard he worked for me on that deal. But we were able to end up getting the properties for around $65,000 a door with new roofs, new HVACs, new hot water heaters. And so they came in and really, really took care of it. And then that was number 2. And so we immediately went from a duplex to a duplex and 5 houses. Right after that happened, at the beginning of that deal, I had started a direct mail campaign. So my wife and I were kind of like, okay, well, we have this one broker, but he's kind of our bottleneck. We have several others that haven't really been bringing us the leads like we want. So we're going to do a direct mail campaign. And I started reading and listening and learning, trying to figure out how to capitalize on that. So we used listsource.com. We also use our local tax assessor website. I know a lot of people heard of ListSource. It basically combs the tax assessor data to allow you to purchase lists that have targeted information. So what we did is same market. We targeted built within the last 15 years, absentee owners, and I wanted them to have owned it for a decent amount of time. So they had an equity position that could stand to have a payout. So they'd be a little bit more motivated. And then we hand wrote the letters to those owners. And that handwritten letter response rate was insane. It was like 50% the first time.
Wow.
And we ended up buying another duplex in that market that was severely under market. It was a lady who had gone to college and her dad bought her the duplex then, and she had just held the duplex for 20 years, I think. And she lived overseas. So she called me and we talked, and I basically, after listening to some negotiation books and things, trying to keep everything open-ended, let them say the first number, you can give them a counter, never commit to anything in real time. I always use my wife as like my gatekeeper kind of. I'm like, well, I got to go talk to her and make sure she's with it. And then we talk and she's like, yeah. And then we come back and renegotiate. But it's a great way to kind of let them know that you're not chomping at the bit, or you're not going to get in a ping pong back and forth, because that usually doesn't end well. People get mad and that sort of thing. So, but on the front end, she threw a number out there just because she had been a little bit detached from the market that was crazy under market, And so I went back and talked to my wife and came back to her and was like, yeah, would you mind coming off 5,000 and covering closing? And if you'll do that, we're good to go. And she did. And so then we stepped into another fully rented duplex. And that was technically the 3rd deal, but I guess the 9th door at that time. So then after that, we were like, this direct mail campaign thing really works. But we wanted to kind of step into something a little different. I didn't necessarily want to do the small residential. I wanted to kind of see where we could go from there from either a commercial standpoint, or I was really interested in the self-storage space. So the 57 door thing is a little bit of a clickbait, kind of, because it was a small self-storage facility. That was a lot of the doors. But with the first 3 deals, we stepped into a large amount of paper equity. So I'm sure most people listening probably know, but you have your cash position and then you have value add, and that value add is considered paper equity. And you can tap into that to then do other things at certain ratios with the bank. So we had generated a decent amount of paper equity. And then our next direct mail campaign brought about a 48 unit self-storage facility that was severely under market too. And we stepped in and bought that and were able to get it stabilized. So those were the deals that we bought while in residency still.
That's awesome. Such a cool story. Direct mail is awesome. We just started doing direct mail for assisted living probably the last 4 months or so ago. Same thing, spent a lot of time. We didn't handwrite them, but we paid a company to handwrite them. And yeah, the response rate has been amazing. In fact, we're at the point where we're like, man, we have so many deals that we're trying to work on and negotiate, like
Wow.
keeping them straight's difficult. And it's been awesome. So yeah, direct mail is a great way to
Good
get.
problem to have, man.
Yeah, yeah, absolutely. So yeah, definitely recommend folks if they're having issues with deal flow, think about doing pretty much exactly what Frankie did, finding a list and tapping into it and getting that deal flow going and generated for you. What was it like pivoting towards self-storage? Is this something that you had to hire someone to work at or a property manager or something like that? How did that work for you?
So this was a smaller facility. It was, I think, 90% full at the time. So it was already stable, but under market. So we got the deal for a great price. So we had a lot of chicken on the bone, for lack of a better word, for us to figure out how to navigate the space. That was one of the things. I probably wouldn't have jumped into that market that early if I didn't feel like it was a grand slam. But as soon as I started negotiating, the seller actually brought the deal with a self-storage facility and a 12-unit apartment complex. Retrospectively, I backed out on the apartment complex and I've kicked myself. I drive by it every week and it drives me nuts that I didn't buy it, but the storage really worked out. And we use all remote based management for the storage. We use a company called Easy Storage Solutions. They bill pay, they do, vacancy tracking, and they do lockouts. We use, without getting in the weeds, we use a DaVinci lock system, which is a radio controlled lock that integrates with the software. And then we use their call answering service. So they handle phone calls for new rentals, problems, and things of that nature. And then they just present the problems to us in email form and we can handle them. It's not a climate controlled facility and there's no on-site employees. So it really is probably considered mini storage. And we've since expanded it to 91 units. So that's how we handle that asset class. And it has been a little bit more active than having a property manager, which I was a little surprised by, but I guess it makes sense because the property manager handles absolutely everything. But with the self-storage, we do occasionally have to, answer phone calls or go out and help somebody get into the gate because we have a lot of older folks who aren't necessarily as technologically optimized. But it's been a really neat asset class and we're probably going to hold on to it for a long time.
That's awesome. So yeah, at this point, still in residency, 57 doors. I would imagine you're making more in your real estate portfolio or close to it than your residency income. Is that correct?
So it was surprising, but yes, we were definitely grossly much higher probably than I was making in residency. Obviously, we were leveraged in the beginning. So a big portion of the transition into being an attending was trying to improve my equity position. Now we try to sit at around a 40% equity position if we can. And we can talk about forced depreciation and how you position yourself from a commercial standpoint. I think that's really probably the most appealing thing about commercial is your ability to force the appreciation and manipulate your appraisal value. And then your position is much more secure. So that's what we try to do at the end of residency. And I never took a dime out of the business. We still don't. We never take money out of the business. We put money into the business some if needed, but we're focused on principal pay down, trying to improve our equity position so that then I don't have to come out of my personal cash to put money down on new investments. I have the last probably 4 deals we bought, I've just pulled equity out, which has been a really neat way to do it.
That's awesome. Yeah, your assets are buying more assets, which is so
For
cool.
sure.
Let's talk about that forced appreciation a little bit, and we'll kind of pivot towards what the portfolio looks like now and the recent deals that you closed, which is awesome.
Absolutely. So I think probably just a little bit of quick terminology. And I think, as you're trying to learn and become vetted when you're talking to accountants and lenders and brokers and things, you need to have this terminology in your head so that you can sound credentialed and make sense. And people give you a little bit of street credit when it comes to negotiating. The first thing is you obviously have your income and your expenses, your gross income and expenses. Well, gross income minus expenses, not including your debt service commitment, is considered your net operating income. So your net operating income is obviously a manipulatable factor. And so if you can step into a deal that is renting for under market and you increase the rent, then you're increasing your gross rents and your net operating income will improve. So that's one. Number two is you can address the expenses. And that's usually something that if it's an absentee owner, if it's been owned for a period of time and it's under market, it's probably mismanaged from an efficiency standpoint. But there are ways, without getting in the weeds, that you could talk about how to optimize that. But we would really try to go through the expenses with a fine tooth comb and see, okay, well, we've been paying, this owner has been paying for this, or this, and I could easily bill back to the tenants, which is the standard for this market. And that would save us this much money. So you can affect the net operating income on both the gross income side and the expense side. When you have a 12-month net operating income, then there's a ratio that you use to then value your property, which is called the cap rate, the capitalization rate. And so basically, sort of in layman's terms, what the capitalization rate is a market-based valuation for a property based on its quality. So you have like an A property, which would be a triple net, Home Depot that's going to be there for 20 years, and they pay a low, the return is low, but the security is very high. They control everything. It's no management. And that would be an A plus property. A B property may be a mini storage that you do have to manage some, and you do have to deal with tenants on a week-to-week basis, but the returns are stable and the likelihood of that asset class folding is pretty low. And then you have a C property, which could be things like government housing or things that maybe are in lower socioeconomic areas, and you're going to have a lot of turnover and a lot of expense associated with that. So typically there's an inverse relationship with the revenue generated based on the net operating income and the appraised value. And that's called the capitalization rate. So I'll just give a little brief example. If you have a property that's worth $100,000, it rents for $1,000 a month, then you can almost assume that expenses are probably going to be around 35 to 40%, and your vacancy is probably going to be 5 to 10%. So then net operating income, you would divide that number by your capitalization rate, which usually is 6% to 8% to 10% if you've hit a grand slam. The higher the capitalization rate, the less expensive the revenue generation potential is. So the better deal, but usually the higher headache. So those factors are being utilized by me to determine if I'm able to add value. Kind of a variable that people don't necessarily consider is sometimes that capitalization rate is manipulatable. If you step in and you buy a property that's a B minus property and it has some deferred maintenance, it's not appealing visually, and you buy it and then you improve the net operating income, then you've already improved your appraised value. But if, say, you've significantly improved the appearance, you are buying in a market that's on the up and up, then it goes from a capitalization rate of a 9, and then you can reposition yourself at a 6, then that exponential paper equity that you've created is what is called forced appreciation. And then when you force the appreciation, that new appraisal allows you to tap into equity to then roll and buy new deals. So that was a very long, convoluted question, but that's the idea, is that you can manipulate the ability to generate paper equity that can then be used to exponentially grow your portfolio at a rate much higher than if you just saved money to deposit on a down payment.
No, that was a perfect explanation. It's such a great way to increase value. For example, if you're looking at like a 100-unit portfolio and you change rent, so you're able to increase rent by $30, like you've added hundreds of thousands, if not $1 million worth of equity to your portfolio. So it's incredible. I heard a gentleman once, he owns a ton of real estate in Missouri, and he added a dog park to his apartment complex. And he said that dog park added like $500,000 worth of value. So there's so many different ways to be creative and force appreciation. It's not necessarily just that rehab potential.
Right. The other thing too, physicians need to consider is that metric that you can increase the value from a forced appreciation standpoint is also met hand in hand with the depreciation potential and the accelerated depreciation potential associated with the value add part of the process. So that's why it's a double whammy for physicians.
Yeah, absolutely. I was going to bring that up next, actually, depreciation and how beneficial that is. Yeah. Do you mind sharing a little bit more about that, what that looks like and how that impacts your taxable income?
For sure. And obviously, you'd have to get a real estate specific accountant. That's what I would recommend first and foremost when you're building your team. Have your accountant so that you're navigating these things appropriately. I think a good real estate accountant that's comfortable with physicians and how physicians are compensated is she basically is probably one of my most valuable team members. So depreciation, basically, if you imagine that a property, due to its wear and tear ownership, has a value decrease every year. So if you buy a property and hold it for 30 years, then there's a schedule at which you get to declare the loss of that weathering. And the interesting thing is when you do additions or you do capital input into properties, you can usually accelerate the schedule at which you can declare that depreciation. As physicians, our number one expense that we have in life is going to be taxes. Now, whether you're W-2 versus 1099 employed, that can be a little more difficult to take passive loss from your investment portfolio off of your earned income. But if you can, I'm a 1099 and my wife declares real estate professional status. And so we're able to take that passive loss at an accelerated schedule. So instead of 27 and a half or 39 years, we can take it in 5 years or even 1 year occasionally. And taking that loss allows me to, instead of paying Uncle Sam 40%, I'm able to pay my future self by investing in some asset that then will provide me return over the next 30 years. So I don't know, that was kind of a convoluted explanation, but basically the assets that you own give you the ability to declare loss, which as physicians, we don't get to do that. That's one of the benefits of being a business owner and having passive investment is that you can declare loss, not have to declare a large amount of income, even though you've made that income in some capacity. And so this allows you to do that. And with things like cost segregation studies on bigger deals, you can pay to have a really large amount of loss brought to the forefront of that declaration schedule. And then if you're able to formulate a plan with an accountant, I think it's a great strategy to buy enough assets that are value add per year to take a huge chunk out of your tax burden. Because why not? Why would you not? As long as your leverage is not, too thin, then it makes a lot of sense to pay your future self with assets than it does to just pay Uncle Sam for things you may or may not agree with.
That's a great answer. Completely agree. I think the tax benefit aspect or the depreciation aspect of income generation for real estate or benefit of investing in real estate gets lost a lot of the time. And so I think it is really important, especially for high income earners and physicians, of course. So that's awesome. Well, what does the portfolio look like now, Frankie? What are some deals you guys are working on now?
Right now, we're basically over the last probably 2 years as COVID, the real estate market has exploded. And so we've done the best we can to kind of capitalize on that. I haven't sold anything recently. We ended up at the end of residency, sold everything we just discussed. We sold the first duplex, the 5 houses, and the second duplex. We kept the 48 unit self-storage facility. But our next play was we bought a large commercial property that was under market in that same downtown market. It was 2 commercial spaces and 5 loft apartments. Added a significant amount of value to that area and done 2 of those units as short-term rentals and then 3 as long-term rentals and added a ton of paper equity. We then parlayed that into a 10-unit commercial strip there and another 2 duplexes that were able to add a significant amount of value to as well. Our play last year was one thing that I think is really neat or really cool about real estate is you can kind of have these goals that you had for your life financially and then double dip by having them be an investment. And so I'm very interested in the outdoors and I have a 9-year-old son and I wanted to buy a farm and we were able to buy a 152 acre farm, 10 minutes from my house here in South Georgia. And our play last year was doing a conservation easement. And that conservation easement allowed us to take a good bit of loss last year. And then we're going to take that tax deduction and just put it down on the note. So it really allowed us to get a big discount on the land that my son killed his first buck on last year. So it's man, the intangible value for that time with him was unreal. And so we did that last year. This year, my wife, there's a small lake that she grew up going to her whole life. And we've always said it was the 15-year plan when I started practice was to buy a lake house there. And this has allowed us to do that. We stepped into a fully furnished, really nice lake house that's 40 minutes from our house and have short-term rented it and it rented on day one. And so we're short-term rented. It's paying the bills, paying for itself and we go and we want to. So that's been a really neat thing that we've been able to do. This month, we're closing on 3 commercial spaces in my hometown now. Kind of the next thing is I want to do some bigger development deals and put some money together and try to figure out how to take a step in that direction. But also I'm really interested in trying to improve the value of my small town. We have a DO school here and they have some larger franchised businesses that have done their due diligence on this market and have put locations here. So I think there's a lot of growth potential and I want to be a part of that. And so we just put a long-term restaurant tenant who already has a good brand in town in a new, nice downtown location that's built out. It's going to be great for them. And then 2 additional triple net commercial tenants. So I don't think I've left anything out. I think that's it for now.
That's awesome. You're crushing it, man. And it's so cool to impact your hometown and impact your town for the better. And a lot of folks are going to benefit from that restaurant, I'm sure, the Airbnb opportunities, the lofts, the commercial spaces. It's awesome, man. You're crushing it. Yeah. That's
it's
cool.
Not rocket science. That's the thing is it sounds daunting when I list it all off, but it wasn't as rapid as it seems. It was rapid, but what I would say is just get started. Get started becoming educated. Get started making a phone call. Get started starting a conversation with somebody that you don't know about your interest in it, just to break down this angst associated with the process and get going. There's a lot of real estate meetup opportunities for you to network with people who have done it. I love networking with people over the internet. I think the internet has really added a ton of value from that perspective, to be able to talk with people who are interested. And if you don't have a real estate meetup, start a real estate meetup. I'm in a really small town. We didn't have one anywhere close, so I started one, and people love it. We'll have a sponsor in the industry and have a couple of beers with everybody and talk shop and talk hurdles and underwrite deals. But also, it's a really fun way to make this a hobby, not just another job.
Absolutely. We don't want another job, but definitely a good hobby. Yeah. Folks ask me all the time what my hobbies are. And I'm like, well, the most important thing is spending time with my family outside of work, but then real estate probably is my only hobby, that and some outdoor activities, hunting, skiing, et cetera. So that's awesome. Well, Franky, if folks want to reach out to you, if they want to learn more about your course, the Real Estate Investor MD course, how can they get in contact with you or learn more about that?
Absolutely. So Real Estate Investor MD is contactable via our social media outlets. You can contact me personally, Franky Davis, on social media. I'm fine. I would love to communicate personally. I'm happy to do that. Our course web URL is realestateinvestormd.com. Basically, the course is a course, and I understand that that's a little pitchy, but my goal is the difficulty associated with physicians becoming educated is just the time constraint. I am unique is the wrong word, but I get up early in the morning and I'm taking care of stuff before my family wakes up. And so I took that time to read the books and listen to the books and listen to the podcast, but that is consolidated in about 7.5 hours of video material. This physician specific. We talk about team generation. I have call scripts for how to contact the teams, deal underwriting, deal flow, how to add value, how to manage. If you want to manage personally, just to learn, or if you want to manage a manager, it teaches you all the factors associated with that. And then the tax implications, we dig into the tax implications and how to exponentially grow your portfolio, which is what I'm trying to do now. Yeah. We have the course for sale, but also have coaching arrangements available as well. So I'd love to talk to people about it, if not just to make more friends over the internet like we have.
Absolutely. It's been awesome. That's great. Well, we'll definitely include a link to that in the show notes there. Anything else we didn't hit on? Anything else you want to add before we wrap things up?
I think so, man. I appreciate what you're doing. I've really enjoyed the podcast.
Yeah.
It's cool trying to help physicians take control of their financial future. I think we're probably one of the most vulnerable populations when it comes to having people pitch things to you as the next kind of get rich because you have money sort of deal. And we have a reputation of not doing well with it. But I think real estate can be a way that you do it fairly safely. I still maximize my tax beneficial traditional retirement opportunities. We do S&P 500 index contribution every month. So I think budgeting and communicating with your spouse about your long-term goals, and then delegating your traditional investment opportunities is probably number one, followed by if you can then not lifestyle escalate a ton and utilize that next amount to a real estate investing career. I think it can be a really nice way to take clinical pressure off. It's done that for me. My goals were to be a real high volume surgeon and take care of this community here and provide my care as much as possible. But this has taken away some of that burnout factor, even though I'm only 3 years in. And I think those are some of the real intangible values.
Absolutely. Well, that's awesome. Franky, I'm so excited to see what the future has entailed for you. And we'll have to get you on the podcast again, like you said, in 6 months or so, see how things are going.
Love to, man. Thanks.
Awesome.
I appreciate the time.
Yeah, absolutely. Well, with that, it's been Dr. Franky Davis and Dr. Alex Schloe with another episode of the Physicians and Properties Podcast. Signing off. Hey, real quick, if you're still listening to this, I'm assuming you got value from it. So I need your help specifically. My 2-year vision with this podcast is to help 100,000 physicians learn how investing in real estate can give you the freedom to practice medicine and live life how you want. There are 2 main ways that a podcast grows. One is through ratings and reviews, and the other is word of mouth. If you can please leave me a 5-star rating and review on Apple Podcasts and Spotify, as well as send this to 1 to 2 friends that you think would get value from it, we can reach the physicians that we want to reach. Thanks in advance, and talk to you on the next episode. Please note that the information shared on this podcast is for informational purposes only and should not be considered financial or medical advice. The views expressed on this podcast are those of the host and the guest and do not necessarily reflect the views of the Department of Defense or the United States Air Force.